Okay, good morning, students. Good morning, Shankar Rao. I can see you on the chat line. Today we are today is the fourth day, and we are in, the subject called foreign exchange exposure and risk management. This is basically the topic, and the course is advanced financial management. And, in the last lecture, we had covered forward contracts. We are trying to cover understand, what are various hedging, how do we hedge currency risk? So we covered money market and other instruments. And today, we are going to do some more questions, and we move on to the practice questions. And the first question, which we are going to do is the question number 12. Okay. So let me just see. You are there. Yeah. Good morning, Shankar. Good morning, Shruti. Good morning, Viraj. Good morning, Satish. So good to see you back. So let's start. This is exercise number 12, which says that an Australian exporter will be receiving $5 lakh in 1 year's time. So basically, the guy is in Australia and he's exporting some goods to USA for $5 lakh. Now, the spot rate of $1 is given. Okay. $1 is 0.0720/25. And then we have the 1 year forward rate also given. Okay. So which is 50/45. Okay. These are the swap points, forward margin. What will be the Australian dollar proceed be if it is hedged? And then because the spot rate is given and the forward margin points are given, so we can easily calculate the forward rate. If at the end of the year, the spot rate is $1 is equal to so many US dollars, what would be the Australian dollar proceeds be if unhedged? And the C part is, would the exporter to be better off hedged or unhedged? Now, there are three parts to it. What will be the Australian dollar proceed if it is hedged? Second, if the spot rate turns out to be different, then, what will be the proceeds if it was unhedged? And then whether the Australian exporter should go for hedging or not. Now, if you look at the quotations, the first is Australian dollar. Now, he's going to first buy US dollar. So we have the quoting, right? It's an, a European code. Sorry, it's an American code. And so we can easily find out. Okay. So what will be the Australian dollar proceeds if it is hedged? Now, an Australian exporter will be receiving $5 lakh in 1 year's time. Now, the spot rate is given to you. Okay, Australian dollar is equal to so many US dollars. So 1 year forward margin is also given to you. So we can just calculate, what is the forward rate by, minusing the swap points, because if you can see, the forward margin points are decreasing. Okay, remember we did a similar question in our second or third day. And then we simply minus these swap points and calculate the 1 year forward rate. Okay, which will be 0.7020 minus 0.0050. Okay, and this is the bid rate, and the ask rate will be minus 7025 minus 0.0045. Now, he is an Australian exporter, so basically the bid price will be important for him, not the ask price. But if you see, the quote has been given in terms of US dollar. That means how much $1 is equal to in terms of US dollars. But actually, we need the indirect quote. Okay, we want to find what is the price of $1. So we can just apply our general rule. So 1 upon we reciprocate and then we calculate. So this is basically 1 upon 0.6980 will become the bid rate, and 1 upon 0.69770 will become the ask rate. So we'll get like this. Okay. So therefore, $1 US dollar is equal to so many Australian dollars. Now we know that he's an exporter, so he will be more interested in the bid rate, because when he goes to the bank, he has got $5 lakh because he's an exporter, so he's going to get $5 lakh. So he is going to go to the bank and would like to convert that money in his home currency. So he'll be using the bid rate. So that means this is the Australian dollar he'll be getting, 7,16,300. So if the proceeds were hedged. Now, if the spot rate turns out to be this, okay, which is, given on the top line, US dollar 0.7025, the header, just look at the header, 7025/30. So this was the rate at the end of the spot rate, okay, at the end of the year. So, which we'll convert into, a dollar quote by doing the reciprocal. That means 1 divided by 0.7030. And the second quote asked will be 1 divided by 0.7025. So we will get this quote. Okay. So $1 will be equal to this. So this is the spot rate after, the end of the year. And then we can apply that. Okay. And calculate how much will be his receipt. So he's going to get Australian dollars 7,11,235, which means he will be, if you look at when he was hedging, he was getting 7,16,000. And now he's getting 7,11,000. So the hedging would be much better option. Fine. So I hope you have understood. Then we can proceed to the second question. So I will be solving some of the questions on the blackboard, and some questions I'll be just, going through, because we have a lot of questions in the study material. I would like to cover mostly all of them so that, it becomes very easy for you when you are preparing for your final exams. Now, ABC Limited of UK has exported goods worth Canadian dollars 5 lakh, receivable in 6 months. So here I'll be asking some questions, so please be prepared to answer them. The exporter wants to hedge the receipts in the forward market. So this is a person in UK and he has exported goods worth 5 lakh Canadian dollars. So he's going to receive this money after 6 months. So he's exposed to Canadian dollars and he's himself in UK. So he wants to hedge. The following information is available. Spot exchange rate, Canadian 2.5. That means 1 pound is equal to so many Canadian dollars. Okay. So now the quote is given in an indirect manner. So we need the quote for Canadian dollars in rather than 1 pound. So we'll just tackle with that once we are solving the question. Interest rate in UK is 12%. So UK it is 12%, and interest rate in Canada is how much? 15%, which means that the interest rate in Canada is higher and the interest rate in UK is lower. So that means the Canadian currency is going to depreciate roughly about 3%, on an annual basis. So for 6 months, it will be around 1.5%. Okay. The forward rates truly reflect the interest rate differential. So the forward rates truly reflect the interest rate differential. That means the forward rates are exactly, matching with the interest rate differentials. Find out the gain loss to UK exporter if Canadian dollar spot rates are, they decline by 2%. Now, if the Canadian dollar declines by 2%, okay, now just look at the question. The question says that, that the interest rate in UK is what, 15%, in 12%, and Canada 15%, which means there is on an annual basis, there will be a 3% decline in a depreciation of Canadian currency. Okay, but we're talking about in 6 months, so that will be 1.5%. So if he takes a forward cover, okay, which assumes 1.5% decline, whereas actually it has declined by 2%. Okay, so is it good for him? Is it good for him? Yes, because of the fact that he has taken a forward cover, which has assumed only 1.5% decline, whereas the Canadian dollar has actually depreciated by 2%, so he will be better off. Now coming to the second part, if the Canadian dollar gains by 4%, now he will be not very unhappy about it, because he has taken a cover which is assuming that there will be a drop of, there will be a depreciation of Canadian dollar by 1.5%, but actually Canadian dollar has gained by 4%, so he's going to make a loss. Okay. Now tell me, in the third case, what will happen? Remains unchanged over the next 6 months. That means the Canadian dollar has neither depreciated nor appreciated. So will it be, advisable, will the forward cover be good for him, or it will bring loss to him? Please answer this question. Any of you? Chandra Rao, Shruti, Viraj, Satish. Okay. So that means it has remained unchanged over the next 6 months. Okay. So that means it was the same rate what it was, but actually, he has taken a forward cover. So will it be, he will be happier person or will he be unhappy about it? So let me know. Happy or unhappy? You can just write that or whatever you want. So let's begin to answer the question. Now, the spot rate, which is given as £1 is equal to 2.5 Canadian dollars. So that means £1 is equal to 2.5 Canadian dollars. So interest rate in UK is 12%, interest rate in Canada is 15%, and the 6 months forward rate would be basically £1 is equal to 2.5 Canadian dollars into the rate of interest in the home currency, which is basically the Canadian dollar. Okay. So if you have to identify which is the home currency, look at the right side, which is Canadian dollars in the code. So 1.075, which is for 6 months, because 15 divided by 2 and 12 divided by 2 will be 6. So we'll use this formula to calculate the forward rate. So 6 months forward rate will be pound is equal to 2.5 Canadian dollars. So in case if you want, I can do it on a board. So let me know. Okay. So this we have already calculated. We know this is the formula where the 1 plus interest rate of the home currency divided by 1 plus interest rate of the foreign currency. Here we have divided by 2. So we have got the 6 months forward rate. Okay. So which is, £1 is equal to Canadian dollar 2.535. Okay. Now, the first case, gain or loss if the Canadian spot rate declines by 2%. If the Canadian dollar declines by 2%, which means the pound is appreciated by 2%. That's the same thing. So that means if he's going to use the forward contract, okay, where we found that the forward rate was £1 is Canadian dollar 2.535. Now this is basically the reciprocal code, so we can just divide and calculate an answer. So the answer will be 1 divided by 2.535. That will be we'll be using into the 5 lakh Canadian dollars. So we get he will be getting 1,97,239 pounds. So how did we do that? We took the forward rate. Now forward rate is is telling you that £1 is equal to so many Canadian dollars, but we need the code for Canadian dollars. So Canadian dollar will be equal to pound 1 divided by 2.535. So we multiply that with what amount we'll be getting from abroad, which is 5 lakh Canadian dollars, straight away we can even divide by taking the original code. So we get 1,97,000. Now, if the receipt as per the spot rate, now the spot rates are that the pound has appreciated by 2%. So that means 2.5 into 1.02. So that means £1 will go up to 2.55. Okay. So if now we convert the pounds, the Canadian pounds into British pounds, so we get 1,96,078. Now he's very he's very happy because the pound has actually depreciated by 2% as against the forward rate, which was assuming a decline of 1.5%. Okay, so he's gaining due to the forward contract. I hope you're understanding. Yeah, that can appreciate. Yeah, so I getting if it remain unchanged, again I'm going to depreciate. Okay, so I'll look to your answers. Okay, fine. Now, if the Canadian spot rate gains by 4%, now in this case, the Canadian dollar is gaining by 4%. He would have been happier if he had not hedged himself because he would have got more money. But since he has taken the decision to hedge himself, so he will not be very happy because why? Because he'll be getting 1,97,239 if he uses the forward rate, which we have already discussed. But now, if the pound, depreciates by 4%, that means the current, it will be if the current spot rate gains by 4%, which means the pound will going to depreciate by 4%. So it's one of the same thing, whether the Canadian dollar spot rate gains by 4% or the pound depreciates by 4%. So we can take the pound rate, okay, and we can multiply it by 0.96. I have done it here, okay. So £1 is equal to US dollar at let me just go, yeah, £1. So I'm just putting my finger here. So £1 is equal to 2.5 into 0.96. Why? Because the pound has depreciated by 4%. So that means the pound will be, equal to 2.4 Canadian dollars. Okay. Now we can just calculate 5 lakh divided by 2.4 because the quote is in pounds. So we are actually calculating the receipts in terms of Canadian dollars. So we are going to simply divide. Okay. And then we calculated that he would have got 2,08,333 pounds if he had not taken a hedge. But since he has hedged himself and he's getting only 1,97,000 pounds, so he's going to lose money. Okay, he's going to lose money. How much? 11,094 pounds. So coming to the third one, okay, which I asked you to give me some answers. So let me just understand. Now, the third one was if the spot rate remains unchanged. Okay, if it remains unchanged, so this money he would have anyway got because he has already taken a forward cover. Okay, so he's getting 1,97,000 because the rate is given to us that 1 pound is Canadian dollar equal to 2.535, which we calculated on the basis of interest rate differential. So we multiply this with the CS rate, which I have shown it in my slide in this case. So 5 lakh Canadian dollars multiplied by 0.39448, or we could have even divided by 2.535, which I did in my other slide. So he's getting the same amount. Now, if the spot remains unchanged, now the spot rate at the beginning was how much, which was given to us in the question, is 1 pound is equal to 2.5 Canadian dollars. So now we divide this by that, 5 lakh pounds divided by 2.5, we get 2 lakh pounds. Okay, so that means if the Canadian dollar would have not depreciated, he would have been happier. He would have, got 2 lakh pounds. Since he has taken a forward cover, so he'll be getting less. So he's again losing due to the forward cover because it was given the question that the rate of interest in Canada is 15% and in UK it is 12%. So which would have meant that the forward rate would be down by 1.5%. So that we assume to calculate the forward rate, and then we find there's a loss. I hope you have understood. Okay, yeah. So the question was, this. Now here, it is like this. So I'm just going to explain that. Okay. Okay, so I'm just going to go to the board and explain the, something which you're asking. Stopping share. I hope you can see my board. Okay. So here, what was written that the rate of 1 pound was given as 2.50. Okay, fine. So this was given in the question. So if you can see the question that this is the spot rate. Okay. Now he says that the forward rates to be different. Okay. If the Canadian spot rate, if the Canadian dollar, so I'll put it properly here. If the Canadian dollar spot rate declines, %2. So this was the question. Now, which means if the $10 spot rate declines, or we can say if we can even say if the pound spot rate appreciates by 2%. So this is one and the same thing. Either current spot rate declines by 2%, or the British pound appreciates by 2%. So if the British pound is going to appreciate, that means Canadian dollar is going to decline. So which means, so the quote would be like this: Canadian dollar 2.50, and we can say 1 minus 0.98. Sorry, this is the second question, was gains by 4%. Okay, so I think I have missed out here. So sorry, I'll do it again. If the Canadian dollar, gains by 4%. So we are doing the second one, okay? Not the first one, okay? Now that means if the $10 gains by 4%, that pound, will actually depreciate by 4%. One the same thing, the pound will depreciate by 4%, the $10 is going to gain by 4%. So which means, if we take the quote again here, if we take the quote here, 1 pound is equal to Canadian dollar 2.5, okay, and multiply this by 0.96. So 100 has become 0.96, okay. It is like this: 1 minus 0.04, which is 0.96, isn't it? So we can just write like this and recalculate my rate, okay. So which will be Canadian dollar 2.40, okay, fine. So which will, if suppose now, we take this amount, which is 5 lakh, Canadian dollars, and divide this by 2.4, okay. So which, that means he's going to get 2,08,333 pounds, okay. But he took a forward cover where he was getting 2 lakh. So he was getting 1,97,239. Okay. So which means he is going to lose. So this is getting, and this was the spot rate. So there is a loss. So we minus this with this. So we get pound how much? 11,094. So if he takes a forward cover, okay, if he takes a forward cover, then he gets this. But if in case in the question, if it says that the $10 gains by 4%, that means the pound will depreciate by 4%. So we recalculated the $10 rate in terms of, we calculated the rate of pound in terms of $10. So which is, the spot rate multiplied by the spot rate after a period. So which is, 2.5, 2.4 now multiplied by this thing. So now we divide this Canadian dollar by 2.4. So this would have been the money he would have got if he was unhedged. But since he has taken a hedge position, so he's getting this much because we calculate the forward rate. So he's losing money by taking the forward rate. So I hope you follow. So now I believe you can see. So have you followed now? Shruti, have you got it? So, so we have done this question. Okay. Now we go to the next question. So please confirm if you have followed. We are moving to the next question now. So the next question is exercise number 14. An importer customer of your bank wishes to book a forward contract with your bank on 3rd September for sale to him of Singapore dollar 5 lakh to be delivered on 30th of October. Okay, good. Tanisha got it. So that's really great that you're understanding. Okay, but Shruti has not confirmed. Okay, so basically, you know, there is an importer who wants to buy Singapore dollar. How many? 5 lakh Singapore dollar. When? On 30th October. Today, 3rd of September. So that means after 2 months. Okay. So spot rate on 3rd September are US dollar, is 80.37 oblique 38. So that means one, dollar is equal to so many rupees. Okay, fine. So, and the second quote is basically given as USD SDT, which is basically, that means, this is Singapore dollar quote, which is 1.3458 and 68. Now, both the quotes are actually given in terms of, European quotes. Okay, fine. So, and calculate the rate, and the swap points are also given. Calculate the rate to be quoted to the importer by assuming an exchange margin of 5%. Now, these are the rates which are given to you. Okay. First, USD versus rupees. Second, USD versus Singapore dollar. Now, if you look at the question, first we look at the USD rupees. Okay, where the quote has been given as, though of course the word the rupee is missing here, so I can just add for your benefit. So this was the Singapore rupee quote. Now, this is the quote spot rate on what? On 3rd of September. Now, the swap points after 2 months, that is October 30th, because these are interbank quotes which are given at the end of the month. So which is 1100 and 1300 would be the relevant, swap points which will be using. Then if you look at the Singapore US quote, then it will be a 2 months forward point, which is 96/97, which will be considering. Okay. Now, since the direct quote of Singapore rupee is not given, so we don't know how much 1 rupee is equal to how many Singapore. We need to calculate through cross rates. The spot rates on 3rd September are $1 is equal to so many rupees, both bid and ask, and $1 is equal to so many Singapore dollars. Now, both are in European. Okay, because we need to, first, of course, we are going to buy a dollar. As I told you, first we buy dollar, and then, assuming that we have gone to Singapore and we are buying 1 Singapore dollar, so we should have a Singapore dollar buying rate, but this is a dollar buying rate. So we have to convert that. Okay, so we have to make the second quote as American to solve the question, or without even, converting, we can just make a division and do that. Okay, we need to buy dollars. We need to first buy dollars and sell our own rupees. Okay, as an Indian, I'm going to sell my rupees and I'm going to buy dollar, and then I'm going to buy Singapore dollars by selling the dollars which I have obtained in my first leg. So buy dollars and sell rupee, the first thing. So 2 month forward rate calculations. So the spot rate is given, $1 is equal to so many rupees, both bid and ask. So 2 month swap points I'm going to take 1100 and 1300, which are given in the question. So I can just simply add them, and they are increasing, so I can add them. So interbank 2 month forward rate will be 80.48, 80.510. Now we are given, now in this case, we are going to buy dollars. So we are more worried about the ask rate. So we'll just focus on the ask. So bank margin is how much? 0.05. So here we are going to, add the margin. In ask, we add, bid we minus. Because, these are the interbank rates. So the bank is going to earn a margin on them. So these are the rates which bank is going to pay to the other bank. So when he pays to the customer, which is called the merchant banking rate, so he is going to be adding to it. So 80.56. So this is the rate as far as the dollar versus rupee 2 months forward is concerned. Now the second one is buy Singapore dollars and sell dollars, US dollars. So the rate, we know that $1 is equal to so many Singapore dollars. Both bid and ask are given. 2 months swap points we picked up from the question itself, which is given in there, 0.0096, 0.0097. Now only thing is that you have to remember that in question it was given 96 and 97. You have to put decimal places, assuming the swap point is 0.001. So I explained to that. So we multiplied and can go take it to the decimal places, and then we are going to simply, and they are again increasing. So we are going to add interbank forward. 2 month forward rate will be 80.48 and 80.510. Okay. Now, since there is no commission rate which is given, so we can sorry, this is given here. Okay, 80.56. So this we have already done. Sorry. So spot rate, $1 is equal to 1.3458 and 1.3468. So we are going to add the swap points, 0.0096, 0.0097. Okay. So once we do this, so we are going to get the 2 months forward rate. So here we have to buy Singapore dollars, but the dollar buying rate is given. So $1 is equal to so many Singapores. So we are going to do the reciprocal of it as the next step. So bid is going to become ask, 1 divided by ask, and ask is going to, now this is the bid rate. Okay. So this is the bid rate. So we bring it here and do the reciprocal. So we get Singapore code. Here also we bring this to this, and 1 reciprocal of this is, so that means 1 Singapore dollar is equal to 0.7319 and 0.73779. Here also we are going to take the bid rate, because now he is going to, buy 1 Singapore dollar. Okay. So cross rate for Singapore dollar on 30th September is given to you. So $1 is equal to rupees 80.56. That's a 2 month forward rate, which is the European rate. So 1 Singapore dollar is equal to so many dollars. So we have got the American and the European code. We have achieved that. So now we can just simply, using this equation, where the dollar cancels out. So we'll be left with rupee Singapore. So 1 Singapore, rate will be 80.56 multiplied. So we just simply multiply, because both the codes are in order, one in European, another in American. Then we can just simply multiply. Had both been European, then we would have answered by dividing one code over the another. So that means 1 Singapore dollar is rupees 59.4363. So rate to be quoted to the importer would be this. So I hope you have followed, and let's. Okay. So Satish Kumar, quote by the bank for selling Singapore dollars is 59.44. Absolutely right. So you got it right. Great. Wonderful. So let's now go to yet another exercise. Satish Kumar, I think you're following everything well. So now we go to another exercise. An Indian importer has to settle an import bill of $130,000. The exporter has given the Indian importer 2 options. There's an Indian importer. He has to pay how much? $130,000. So the exporter, which is he has given him 2 options: pay immediately without any interest charges. Okay, pay immediately without any interest charges. Pay after 3 months with interest rate of 5% per annum. So this is the second choice. The importer bank charges 15% per annum on overdrafts. The exchange rates in the markets are as follows. The spot rate is given, okay, which is $1 is equal to 83.35 and 83.36, which is the ask rate. Okay, so he is an importer, so the ask rate will become more important for us. 3 months forward rate is also given. The importer seeks your advice. Give your advice. So if the importer pays now, he will have to pay US dollar in spot market by availing the overdraft facility. So accordingly, the outflow will be as follows: So amount required to purchase $130,000 would be, we are going to use the spot rate, okay, which is 83.36. If you look at the bottom of the screen, the 83.36 is the rate we are using to calculate how much he will be shelling out in terms of rupees. Now, since he has taken the spot rate, he is going to add, because he has taken it for 3 months, okay, overdraft. So at the rate of 15%, he is going to pay 4,06,380 as an overdraft. Okay, so total outflow will be 1,12,43,180. Now, why we have it the interest? Because he is going to avail the overdraft facility. And now, second is that we are comparing it with the forward rate. So to make an absolute apple-to-apple comparison, we have to add interest on it. Okay, fine. Now, if the importer makes a payment after 3 months, then he will have to pay interest for 3 months at the rate of 5% per annum for 3 months, along with the sum of import bills. So that means he's going to pay 3% interest to whom? To the exporter. Accordingly, he will have to buy dollar in the forward market. The outflow under this option will be as now. The second choice, he's going to make the payment after 3 months at the forward rates, but along with 5% rate of interest. So that means amount of the bill is 1,30,000. So he's going to pay another 5% per annum as interest. So if we add 5% per annum interest to 1,30,000, it will come to $1,625. So that means amount to be paid in Indian rupee after 3 months would be 1,10,000. 1,10,34,124, which is $1,31,000, which includes the interest for 3 months, 1625 into 83.83. So now the outflows, we know the outflows under both the conditions. First, when he takes the overdraft facility in India. Second, where he doesn't take the overdraft facility, but he pays 5% interest to the foreigner from where he is, importing. So he is going to pay him 5%. So which means the option number 2, the outflow is lower. So since the outflow in the cash is, is least, second option, since the outflow of cash is least in the second option, it should be opted for. So that means he should, ask the importer that he will make the payment after 3 months to him, along with interest, using the forward rate. So he should go for forward rate, which will give him the best return, the best kind of a situation. Now, I hope you people are following. Okay. So now we do another example. So we will be quickly solving most of the questions which are there in your study material, so that when you are looking at your study material, you will find most of the questions have been answered well, and even it will be quite helpful. An Indian importer has to settle an import bill for 1,50,000. Now, this is a question which I would say that you need to do it. So please, immediately ready with your a notebook and pen, so that you can solve. So same question, but with different numbers. So an Indian importer has to settle an import bill for 1,50,000 dollars, pay immediately without any interest, pay after 3 months at the rate of interest for 4%. Importer bank charges 12% for the overdrafts. The exchange rate in the markets as follows: spot rate is given, 3 months forward rate is given. So now let me know which option is better. So please do that. So quickly, please do it. Okay. I'll wait for a minute or so for your responses. It's simple one. Just try to do it hurriedly so that we don't miss out other questions. So as you are solving the questions and putting your answers in, after half a minute, I'll start, going for the solution. I'll show the solution so that by the time you would have, opted for your responses, I believe. So in case if you have followed, let me know. The only, important is that to understand. So amount required to purchase 1 lakh is this. Overdraft interest is 3,57,000. So total outflow in case of an overdraft will be this. Okay. So I'm just going to wait for a couple of minutes, a minute more maximum. Then if the importer makes the payment after 3 months, then he will have to pay the interest for 3 months. So if the importer makes the payment after 3 months, then then he will have to pay 3% for 3 months, 4%. Okay, so that means he has to pay. Yeah, Namrata, you're getting So you're getting 1 crore 22 lakhs 61,120. Absolutely fine. Now let me know what is the have you followed the second one where he goes and pays the money along with the interest, okay, without availing the overdraft facility, okay. So anyway, you just try to put your answers so that I can understand that you have followed it, okay. In case not, then I have to pay immediately. He will be benefit to pay immediately, which is 1 crore 22 lakh 45,000. So in this case, he will be benefit pays immediately. So if he pays immediately, so it is 1 crore 20. So the first option was pay immediately. Okay, first one, and pay. Okay, pay immediately is coming to be the first option, which is 1 crore 22 lakhs 61 lakhs. But he pays in forward market, he has to pay only 1 crore 22 lakhs 45,000. Just calculate that. If my calculations are okay, then it seems that the second option would be better. Okay, fine. Three months rate is 80.83. So tell me if I have not made a mistake while solving it, because he's saying immediately benefit pay after 2 months. Absolutely right. So Prashant, yeah, the question answer is coming 1 crore 22 lakhs 45,745. So benefit to pay after 3 months. Very good. So let's move on to the next question. Okay. So there is a company called Gibraltar has imported 5,000 bottles. Now this is also kind of a similar question. So I'm just going to run through very fast here. Okay. So he's he's an importer. He is importing shampoo, this thing, and each bottle of shampoo is 20 each. The company is has a choice, again the same kind of a choice, where he has to pay immediately, or it has a clean overdraft facility where 14% per rate is charged. Okay, so calculate which of the following method would be cheaper to Gibraltar. Pay in 3 months' time with interest rate of 10% and cover for 3 months. Settle now at the current spot rate and pay interest for overdraft for 3 months. So first would be to pay along with interest in the forward market by taking a forward cover, and the second would be to pay immediately, okay, using the overdraft. Now, only thing is difference is there. The rates are given to you, where the rates are $1 is equal to 79.25, 79.55, and 3 month swap points are given 35.25. Remember, the points are decreasing. So that's the only difference here. The points are decreasing. So we will calculate the rate by minusing. So repayment in 3 months' time would be $1 lakh, adding 10% rate of interest for 3 months. So it comes to $1,02,500. So the spot rate is given. 3 months forward swap points are given. So we are going to calculate the forward rates. So here the ask rate, which is meant for the importer, will become important. So we will multiply this by 79.3. So that means the total outflow will be 81,28,350. So only difference is that in this question, the swap points are given and they were in decreasing order. So we have to calculate the forward rate. We have minus them from the spot rate. So we arrive at the rates. So that's the only difference. And then overdraft facility. So we just simply add the interest, okay, because he's using the spot rates to get his money, which is 79.55, okay, and where that means he's going to pay 79,55,000, okay. but then he has to pay interest because he's going to use the overdraft facility, so which will be going to be 2,78,425. Total outflow will be this much. So option 1 should be preferred as it has lower, this thing. So if you look at the option number 1, it was 81 lakhs 28,000, and in option number 2, it was 82 lakhs. So which means the option number 1 will be better. Now, why I've done it in faster manner, because this is similar to the question which was there. So 3 questions, why swap conducted not clear. Okay, Namrata. So if you remember that, if the rates are the bid and ask swap points. So 35 is the bid rate and 25 is the ask swap points. If they are decreasing in the decreasing order, okay, so what we take, we take the spot rate and minus the swap points. Okay, had it been, like this, it would have been, 25 and 35, then we would have added. So that means the dollar is trading at premium. But here, this is signifying that the dollar is trading at this, dollar is depreciating in the future. So here we are assuming that dollar is depreciating because the bid is higher. The bid is always lower and ask is always higher. So that is the normal thing. But in this case, the bid is higher and ask is lower, which means the dollar in the forward market is trading at a discount. Okay, is depreciating. So look at the the forward rates here. The spot rate was 79.25 and the forward rate is 78.90. Okay, after 3 months. Now, normally it doesn't happen in case of a dollar versus rupee, but sometimes do happen. So here, both the quotes, which are, the forward quotes are, lesser than the spot quotes. So here we are telling you that the dollar is going to depreciate in the next 3 months. So that's why we always minus. Now, you should always remember, whenever the swap points are given like this, where the bid is higher and ask is lower, then you minus it from the spot rate instead of adding. But if it is the other way around, if the bid is lower and ask is higher, then we simply add them. That would mean the dollar is trading at a premium in the forward market. Here, the dollar is trading at a discount in the forward market. So in the which question you're talking about? In the question number 19. So let me just see. So in question number 7, this forward rate is going to depreciate compared to the, so it is better to cover the, okay. So here we are getting this, fine. So option number 1, which is basically using an overdraft facility, would be better. Okay. So let's go on to 20. So I think, Satish, you need to check again. Let me know whether you have followed. Okay. Namrata, I hope you have followed. Okay. This was, if you watch my, lecture number 1 and 2, I mean, then it will get absolutely clear to you. And I had tried to make it clear to you again now. Okay. But watch my earlier videos, so it will give you a much clarity. Now, this is a very good question. Exercise number 20. Okay. So please focus now. This is going to be a good question. So JKL Limited, an Indian company, has exported has an export exposure of Japanese yen. How much? 1 crore Japanese yen. Receivable August 31st, 2014. Now, Japanese yen is not directly quoted against Indian rupee. Okay, this is not quoted. So the current spot rates are given to you. So, $1 US is equal to 62 Indian rupees, and the Japanese yen versus US dollar also rate is given to you. Okay, so that means he has got an exposure. He is an exporter, so he's going to receive 1 crore Japanese yen when receivable in the month of August. Okay, fine. and the rates he's going to receive money. So that means the bid rates are going to become important. But anyway, there's no bid and ask rates given in the question. So the spot rate are given, okay, fine, which is given at the bottom. Okay, now it is estimated that the Japanese yen will depreciate to 124 level, and Indian rupee to depreciate against US dollar would be 65. Forward rates for the August 2014 are INR versus US dollar is 66.50. Japanese yen versus US dollar is 110.35. Okay. Then required, calculate the expected loss if the hedging is not done. How the position will change if the firm takes forward cover. Okay. So calculate the expected loss if hedging is not done. How the position will change if the firm takes the forward cover. If the spot rates are given to you as follows, which is 66, and Japanese yen is this, is the decision to take. Now these are the spot rates on 31st of 2014. That means the spot rates which are going to be there on 31st day when he is going to actually get his receivables. So because now is his decision to take forward cover justified? Now let's go back and see. He is basically whom he is. He is a exporter. So he's going to get $1 crore. So that's very important to understand. So if he's going to, now let's go back and see if he's going to get, Japanese yen. So if, the Japanese yen appreciates, he's going to get more money. If the Japanese yen depreciates, he's going to lose money. Okay. But I think in this question, the Japanese yen is getting depreciated. Okay. So let's see under which situation, the Japanese currency is losing most of its value. Now, first, look at the spot rate here. So look at the spot rate, which says, the $1 is equal to 62.22. And one, US dollar is equal to so many Japanese yen. Okay, fine. So now that means one Japanese yen would be 62.22 divided by 102 points. So this should be 60. Let's go to the spot rate. It should be 62.22. So I have to make a correction here. Okay. So 62 points. So if we do that, okay. So let's say how much is the rate. So let me just check through the calculator. So do that. So now this quote is given as $1 is equal to this thing, and $1 US is equal to so many Japanese yen. Okay. But we need a quote in terms of Japanese yen. Okay. So we can just achieve it by dividing it. Okay. Or we can say 1 divided by 102.34 multiplied by 62.22. So we'll get the same answer. Okay. So let me just see that my calculations are right. 62.22 divided by 102.34. So it is 0.6079. So the answer is right. Okay. So these are the spot rates given to you. Okay. Now the expected spot rate, which is given on August 2014. Now these are the spot rates, the day, different spot rate. Okay. The expected spot rates are, which is, 65 is the rate of US dollar versus rupee, which he has calculated. So now this I've done is I'll just show you here. Sorry, I'm just moved very fast. Okay. Okay. So this was the spot rate. First, we use these spot rates. Okay. The current spot rates. Okay. The current spot rate was 62.22 divided by 102.34. Then, so this is the estimated Japanese yen that will depreciate how much. Okay. So it is 65 divided by 1.24. Okay. So then the forward rates are given. Okay. And then finally, the spot rates are also given on August 31st. So there are 4 kinds of rates which are given. Okay. So the first is the current spot rate. So this is, I'm going to add the word here so that it doesn't means any confusion in mind. So I say current spot rates. Okay. So these are the current spot rates. So this is the current spot rate. Now this is the expected, rate, which is, he assumed that the US dollar would be 65 and the US dollar versus Japanese will be 124. So we calculated one Japanese yen will be equal to 0.5242. These are the forward rates which are given in the question. So which is assuming that one Japanese yen will be 0.6026 and the spot rate on 31st. So I think it requires explanation on the board. Okay. So I'm going to, get up and explain that on the board. Okay, fine. So this is basically question number 20. So where you have given current spot rates. Current spot rates. Okay. Then expected spot rates are also given to you in the question. Expected. Okay. That is expected in the month of August when he's going to get his money. 2014. Okay. Then the forward rates are also given. Which is August 2014. And finally, the spot rate is given on August 2014. So 4 kinds of rates are given. So the first rate which is given to you is $1 is equal to how much? Rupees 62. Okay, fine. And one, $1 is equal to 100 and how much? 102.34 yen. So these are the rates which are given to you. Okay, fine. Yeah. So now, how much we can calculate? What is one Japanese yen? One Japanese yen, which will be equal to rupees, which will be, how we can do is, we can calculate is by 62.22 divided by 102.34. Now, here both are European. Okay. First, we are going to buy US dollar, then we are going to buy yen from surrendered US dollar. So the quote is actually inverse or reciprocal. So that's why we made a division. So that means one Japanese yen will be equal to how much? 0.6080. Okay. So 1 rupee here. Okay. Fine. So here I will say that 1 rupee will be equal to 1 Japanese yen will be equal to. Yeah, and I think I just making a mistake. So 1 rupee will be equal to 0.0680. Again, I'm writing wrong. 1 Japanese yen is equal to rupees 0.06080. So one Japanese is missing. So this is rupee. So I will just write it as rupee, but it is one Japanese yen. So this is the first case. Okay. Now expected rate. Expected rate we know is 65 rupees. And yen is how much? Yen is 124. So this is what you are expecting. So that means one Japanese yen will be equivalent to how much? Which will be, will be 65 divided by 124. So which will be 0.06. Expected will be, sorry. Expected will be 0.52. Okay. Fine. So this is the current, the yen has depreciated. Okay. Then forward rates. The forward rate which are given to you is 66.50 rupees, and yen it is given as 110.35. Okay. So we do is 66.50 divided by 110.35. So we get the answer is one Japanese equal to rupees how much? 0.6026. Okay. So first we are calculating all the rates. Okay. Now the spot rate, we know it is 66.25. Okay. So this is rupees, and yen would be how much? 110.85. Okay. So this will be 66.25 divided by 110.8. So this will be 0.58. Sorry, 0.5977. 0.5977. So these are all the rates which we have calculated. Okay. Now, which is the best rate? Of course, spot rate is, the spot rate, the expected rate is this. So the choice is between the three. So if he takes a forward hedge, he's going to get, if he's going to take a forward cover, he's going to get this. He's going to get 0.6026 per Japanese yen. So this is the best. Because here the Japanese yen is depreciating. Okay. It started with 0.60. He was expecting the depreciation to be much higher, but actually turned out to be only 0.6026. So, and the spot rate was 0.5977. So he should not go for this. He should hedge his position. He should hedge himself, because in hedging he is getting the best rate. If he would have not hedged, he would have got only 0.59. Okay, right. So let's now move on to the answer again so that you can understand. So I have calculated this on the board. Okay. Now, let's do one by one. Suppose the expected rates had materialized. So value of export, what would have been the loss, without hedging? Suppose, the expected rates were the rates at which, things would have come. So he would have got, value of exports at the time of export was. So at the time when he exported, the rupee was 0.6080. So if you multiply this by yen, so you would have got this much of rupees. But the estimated payment would have been in the month of August 2014 would have been 0.5242. Okay, into 10 crores of yen. So he would have got 52,42,000 which would have meant that he would have lost 8,38,000 rupees. Because at the time when he exported, the rate was 0.6080, and his estimation was the rate would depreciate to 0.5242. So he would have lost his money if his expected rate would have materialized. The next was, the loss under the forward cover, because the yen is depreciating in all the conditions. So we have to find under which condition the loss is the least. So value of export, the time of export was 60,80,000. When he would have taken a forward cover, he would have got it at 0.6026. So he would have got 60,26,000. So that means he would have lost only 54,000. So the forward cover would be, as we can see, would be giving you the best rate. Now, the actual rates on August 14, the spot rate which happened on the August 2014. So if he were not hedged, he would have got his money at these rates. So the value of export at the time of export was 60,80,000. Estimated payment to be received on now this can be written as payment to be received would be, it is estimated only because the spot rates are given now. So it would be 0.5977 multiplied by 10 lakhs. So he would have got 59,77,000. So he would have lost 1,03,000. If you are not taken a forward cover, he would have lost 1,03,000. If you have taken a forward cover, he would have lost only 54,000. So the decision would be to go for forward cover. So let's look at see whether we have solved all the points. So this was the question. Okay. So here required calculate the expected loss if hedging is not done. Okay. How the position will change if the firm takes a forward cover. So we have done it. If the spot rates are August, we have used it. Is the decision to take the forward cover justified? So answer would be yes. Yeah, Satish Kumar, you're absolutely right. Please confirm if you have followed, then we can move to the next question. Exercise number 21. So exercise number 21 says you, a foreign exchange dealer of your bank, are informed that your bank has sold a TT on Copenhagen for Danish kroner 10 lakhs at the rate of 1 Danish kroner is equal to rupees 6.5150. So 1 Danish kroner is equal to rupees 6.5150. So the question says that you are a foreign exchange dealer, you're a bank, and you are informed that your bank has sold a TT on Copenhagen for Danish kroner amounting to 10 lakhs Danish kroner. The rate was 6.5150. So that on that day, the Danish kroner was 6.51. So he has sold a TT to someone at this rate. You are required to cover the transaction either in London or New York market. So basically, as a banker, you are selling a TT to your customer. Okay, he came to you and you sold the TT at 6.5150, rate equal to 1 Danish kroner. So now, since you have sold him, so you like to cover this transaction because you don't take the exposure on your shoulders. The bank would immediately cover this transaction. Okay. So he has to cover either at London or the New York market. So the rates on that dates are as under. So rates are given. In the question paper, the rates were given, but I have just, made them, red and green. So these are the rates which we are going to use them. Okay. So that's why I have marked them. So the rates are Mumbai, London, 1 Great Britain pound is equal to rupees so and so. Now, since you're going to buy something, that's why the ask rate we have chosen. Okay, since you're selling, TT, so you need to now cover yourself. Okay, you have sold, now you have to buy in the interbank market. So the ask rates are important here. Mumbai, New York, rate for the US dollar is 49.25 and 49.2625. London, the rate of Danish kroner is given, and as well as in New York, the quotation for Danish kroner is given, both in terms of bid and ask. Okay, in which market will you cover the transaction, London or New York? And what will be the exchange profit or loss on the transaction? Ignore the brokerages. Now let's proceed to solve this. Now the first, he has sold a TT. He has sold a TT. How much? 10 lakh Danish kroner. What is the rate at that time? 6.5150, which is given the question. So that means if he has sold a TT worth 10 lakh Danish kroner, the banker would have got 65 lakh 15,000 from the customer. So a customer came and he says that I want a TT to be sent to Copenhagen for 10 lakhs Danish kroner. So the bank will say, okay, give us 65 lakh 15,000 and we'll give you a TT for 10 lakhs so that you can send it to your your supplier. So which means the bank would be receiving 65 lakh 15,000 for selling a TT. Now you need to immediately cover this. When you're covering, you should not be making a loss. Okay. So Mumbai London Bank, we know that the rate of one Great Britain pound is 74.32. And the rate of one Great Britain pound in terms of Danish kroner is also given to you. So two rates are given. One is 1 pound is equal to how many rupees, and then the rate in terms of pound in terms of Danish kroner is given. So now, since you have to first buy, a pound, okay, by using your rupees, and then you go to, buy a DKK, that is Danish kroner. So you need to convert that. 1 DKK would be 1 divided by so many pounds. Okay, so you're converting your bid and ask in terms of pounds. Since you have bought pounds, okay, now you have bought pounds, and now you're going to buy Danish kroners, okay, by using your pounds. So that's why you're going to convert this quote. First step is number 1 is that first you're going to buy pounds. Then you're going to use your pounds to buy DKK. But the rate is given for buying pounds, so you convert in the rate to buy DKK. So here I've converted, use this formula, and then you'll find that rupee oblique Great Britain pound into Great Britain pound divided by DK. So GB pound bond will cancel, will become rupee upon DKK. So that means this is the rate for 1 DKK, 1 Danish kroner. So 1 Danish kroner would be, since the rates are, given this thing, so we can just make a division, or we can multiply this. 1 DKK will be 74.32 into 1 divided by 11.42. Okay, fine. So, or we can do simply a division, okay, by taking that rate. So we get the rate will come to 6.507881. So that 1 Danish kroner in London is selling for, you can buy 1 Danish kroner for 6.50. Now, since he's going to buy 10 lakh Danish kroners, so he's going to spend 65 lakh 7,000. And if you remember, he has sold already Danish kroner in India for 65 lakh 15,000. So he's going to make a profit of 7,119. So let's go back and see. So he was, he has sold for 65 lakhs at 6.5150. Now he's covering this transaction in London at a lesser rate, which is 6.507881. So he is making a profit of 7,000 rupees. Okay, if he covers in London. So let's see if he goes to New York and covers the same transaction. So there, $1 is 49.25, and 1 USD is equivalent to so many Danish kroners, both bid and ask. So then we are going to convert this rate in form of when he's going to buy DKK, because he's going to buy first dollars, and then he's going to surrender his dollars and buy DKK. So we should have the quote in terms of DKK. So that's why in the third box we have converted into 1 DKK will be these many, this thing. So we use the same formula, and we will have rupee upon USD, and into USD upon DKK. USD is cancelled, so rupee upon DKK will remain. So this will be nothing but 1 DKK is equal to how many rupees? Okay. So this will come to 1 DKK will be equal to 49.2625, which is the dollar rate, divided by 7.5670, which is this rate, okay, which is the ask rate, which will become, we are going to use this, okay, and so we get 6.501076, okay. So he's going to buy. So that means he's going to get this much. So 10 crores into 6.50. So the rate was 6.51. Okay, fine. So that means he has to pay 65,10,176 for covering this in New York. So he was making, he sold the TTD at 65,15,000. And if he covers in New York, he gets 65,10,000. So he makes a profit of 4,824. So he makes a lower profit in New York as compared to a higher profit in London, where he's making 7,119. So he will prefer to go to New York. Okay. So let me just check here. London it was. Yeah, absolutely right. So, which means the transaction would be covered through London, which gets him a maximum profit, which gets him a profit of 7,119. Okay. So when he was covering in London, he was getting a profit of, if you look at, London, he was paying 65,10,000 to cover the same transaction. When he was going to New York, he was, the cover was 65,07,000. So he's actually making a profit, more profit of 2,225 by covering in London. So let's look at this. So here he was, New York, he was paying 65,10,000. Okay. And New York, he was paying 65,10,000. And in London, he was paying 65,07,000. So that means he's making an extra profit of rupees 2,295. Okay. If he covers in the London interbank market. But if he, the overall profit he's making on the transaction is 7,119. Okay. So that's it. So this is, so I hope you have followed. So if you haven't, please raise your question. So it will take cover. What does it mean? That's very important, now, whenever the bank is selling, so let's go back and understand cover means what. Okay. So that was a very important question which you asked. Now, what happens is, Prashant, that, when you go to the bank, suppose you go to the bank and you have to send some money abroad. Okay. Now assume that you're importing something from Denmark. Okay. And the currency there is Danish kroner, assuming that. So you are have to pay 10 lakhs, Danish kroner to your supplier. Okay. Now you go to the bank and you tell the bank that I need a telegraphic transfer. That means you please transfer this money to my supplier's account. So the bank will say, okay, we'll transfer it. How much money you require? 10 lakh Danish kroner. So they check the rate. Okay, the interbank rate, they found that 1 Danish kroner was 6.5150. Okay, fine. So which means that, they'll be spending this much of money, and with this money, they'll be going to take from you. Okay, so they took this money from you. So you paid 65,15,000 rupees to get a telegraphic transfer to your supplier. Now bank has sent it. So bank is now exposed to Danish kroner because they have actually paid someone 10,000. So these are the banks. So they go and check the interbank rate and give you the TT. Now, since now they have to purchase this, they are selling to you. Now they are going to buy it in the interbank market. First, they have to buy it from the interbank market. Then only they are going to sell it, isn't it to you? So they buy it first and sell to you after checking. So the bank doesn't have Danish kroner with him. He's going to check the interbank market and he will buy the Danish kroner in the interbank market. See, once he has sold to you, he's going to buy. So both the processes are done immediately so that the bank has no exposure to the foreign currency. So they will, go and check both at London and New York, for example, in this question. So when they check in the London, that if they are, going to, they have sold now, they're going to buy, so they're going to buy now DKK, okay? Rather than the process, they buy first and sell later, okay? So they're going to buy. So when they buy, they found that they could have bought it at 6.50788. Now they quoted a higher rate to the customer at 6.51. So that means in the process, they were making a profit of 7,119. Okay. So the bank, when you go to the bank to buy dollars or any currency, they need to basically, go to the interbank market and procure your dollars if you are an importer. If you are an exporter, you are going to give dollars to them, they're going to sell those dollars in the interbank market similarly at the same time. So they're not going to keep any exposure. And in our next, maybe the last day, we are going to talk about trade of forward contracts. We're going to exactly understand this covers, okay, more in detail. So in the meantime, you can just, understand the bank needs to cover their exposures immediately. If they are selling, they have to buy in the, in the interbank market. If they are selling to the customer, they have to buy in the interbank market to fulfill your needs. Okay. If they are buying from you, you're an exporter, they're going to sell in the interbank market immediately. Okay. So that they don't have any exposure in foreign currency on their head. Okay. So that is what we have covered. Now we go to the next question, which is exercise number 22. Okay. Okay. So now this question is again similar one. Okay. Here also the bank is going to cover. Now you sold Hong Kong dollars 1 crore value spot to your customer. Now you means a bank. Here the bank is selling 1 crore Hong Kong dollar, their customer at rupees 5.7, and covered yourself in London market on the same day when the exchange rates were. Now, please understand this. So this will, settle everything in your mind. The bank, in one hand, is basically selling. On the other hand, they're covering the same transaction in the interbank market so that they don't have any exposure to the Hong Kong dollar on their head. Okay, and rather they would be making a profit by selling you at a lower rate and buying it in the market at a high they sold it, so they will be selling and they will be buying at a lower rate on the interbank market. So here, one Hong Kong dollar, one US dollar is equal to so many Hong Kong dollars. And local interbank rates for US dollar is also given. So one US dollar is equal to so many rupees. So now, the two rates are given to you in terms of, Hong Kong dollar. That means how much, it will cost. One US dollar will cost in terms of Hong Kong dollar. And similarly, one US dollar would cost how much in terms of rupees. Now, first, what they are going to do is they are going to buy dollar, and then they are going to sell the dollar and buy Hong Kong dollar. So this is the process what they are going to do. Calculate the cover rate, ascertain the profit loss in the transaction, ignore the brokerage. Okay. So let's talk about this. The rates are given to us. The spot rates are given, USD versus INR and USD versus Hong Kong dollar. Okay. So both are European in nature. So we need to convert one of them into American, the second one, because the first one is absolutely in order that you have to first buy dollar. And then you're going to buy a Hong Kong dollar. So in the second row, we have converted that into Hong Kong. So, if you look at the second box, the first quote is okay. So you're going to buy, dollars at 42.85. Then you're going to, go to the Hong Kong market and, you're going to buy one Hong Kong dollar. Okay. And the rates are given 1.7920, which will be, and 1 divided by 1.75. So both the rates are given. Okay. So this will become here bid. Okay. And this will become, so this is 1.759. So this is bid and this has become ask here. Okay. Fine. So in both the cases, ask rates are relevant. So they are going to first buy US dollar and then they are going to buy one UK dollar, one Hong Kong dollar. In both cases, we are going to look at the ask rates. Okay. So if we just multiply this 42.85 and if we divide this by 75801 divided this, so we get the cover rate as 5.64. So that means the cover rate is, that means they're going to go and buy one Hong Kong dollar immediately. They find it was 5.647, but they have sold you at 5.70. Okay. They have sold you at 5.70. So they are making a profit of 0.5290 into 1 crore Hong Kong bank. So they make a profit of rupees 5,29,257. Okay. So this is, so just to summarize again, if it's a small question. Now, you know, the customer, you have sold to your customer Hong Kong dollar at the rate of 5.70. Now, how you sold it? First, you check the rate, you know, at what rate you are going to buy it. Okay. And then you sold at 5.7 so that you make a profit on that, isn't it? So the rates are given to you both, you know, for buying one US dollar and then for buying one US dollar in terms of rupees as well as one US dollar in terms of Hong Kong dollars. But now you need to convert them properly so that you can find. So both are given in European terms. So first, what he's going to do? He's going to buy a dollar. You know, first he's going to check at what rate you can buy a dollar. So dollar rate is 42.85. The second thing would be going to check what rate he's going to buy an Hong Kong dollar by selling his US dollars. So here the two rates are given to you. So we just simply, you know, take 42.85 and divide this by 0.7588. Okay. So this is the bid rate, but this will become the ask rate here. So he's going to divide that and he's going to get a rate. Rupees 5.647. So once he found that he can buy a Hong Kong dollar at 5.64, now he's going to sell to you at how much? 5.78. So that he makes a gain out of this transaction. Okay. So now he makes a profit of how much? 5,29,257 rupees. Okay. I hope you have understood. In case if you have understood, please, you know, exchange rate point. Okay. We need to buy dollar and then confusion. Okay. What is that? Kumar Jyoti. Why we need to buy dollar? I am having confusion in which currency to buy and which currency to sell. Now, Kumar Jyoti, it was very simple. You know, if you have heard my original lectures when we covered the basics. So if you look at, I'm just going to explain, you know, before we go for a break, you know, I told you, you know, that, you know, if you have to buy now the two rates are given to you. Okay. The US dollar versus INR and USD dollar versus Hong Kong. First, since the rate direct quotation is not given for buying one Hong Kong dollar, you want to buy one Hong Kong dollar, the quote is not given. So you have to use the cross rates. Now, first, we need to buy a dollar. Now, I told as an example last time, you know, my first lecture, that about 25 years back, you know, whenever you're traveling abroad, you used to buy dollars. Whether you're going to US, whether you're going to England, whether you're going to Thailand, or you're going to Singapore, or you're going to any country, or England, or Germany, you used to buy dollars. And then go to that country and convert your dollars into the local currency. You sell your dollars and buy the local currency. So similar logic is here. The cross rate also, you know, I mean, is based on the same. Everything is now digital. So you get all the currencies in India itself, whether you want to buy dollar or you want to buy euros or pounds. So you don't have to buy a dollar now. You can simply buy a pound or euro. If you're traveling to London, you have to buy pound. So you can buy the pound in India. Okay. But the rates are always, you know, worked out on the basis of dollars. Okay. So first you buy a dollar. Think about, you know, 25 years back, you used to go and buy a dollar first. So you're going to buy a dollar. So dollar today is trading at 42.85. So this is the rate of the dollar. Okay, fine. Then you have the dollar with you, $1. So you go and buy one Hong Kong dollar. Suppose assume that you have traveled to Hong Kong and you're going to buy Hong Kong dollar. So what is the rate here? 1 divided by 1.75. Now, if you multiply these two, you will get the desired rate, which is 1 Hong Kong dollar will be equal to how many rupees? So you just simply multiply this 42.85 into 1 divided by 1.7588. Okay. If you do that, so you will get 1 Hong Kong dollar rate. Is that? So 1 Hong Kong dollar rate would be 5.64. Okay. Fine. So now since you are going to, buy the Hong Kong dollar at 5.6471, so you have to sell it at a higher rate to your customer. So you sold it to it at 5.70, thereby making a profit of 0.5290 paisa. Okay. Which you multiplied by 1 crore is Hong Kong dollar. So you'll get total profit in this transaction, which is 5,29,000. I hope it is clear, but Kuwari Jyoti, you need to basically, revisit my earlier lectures. Okay. Once you listen to them, the confusion will not be there. Okay. So currently you are in a confused state. So that confusion will get cleared if you listen to the first video, okay, which I have covered the basics. So now we are going to have a break for 15 minutes. Okay. So a break for 15 minutes. So we meet at 8:45. Okay, see you at 8:45. Okay. So now we'll be doing yet another question after the break. Let me just show you the question. So this is also a very good question, a little bit tricky. Okay. So this is question number 23. Okay. We have 23 and then we have 24. Okay. Good. So let's begin. On January 28, 2013, an importer customer requested to a bank. I hope you're able to see me now. Yeah. On 28th of January 2013, an importer customer requested to a bank to remit Singapore dollar 25 lakhs under an irrevocable letter of credit. So basically, there's an importer. He wants to make a payment. How much? 25 lakhs Singapore dollar. He has opened an LC, so he says that remit this money to my supplier, and he approaches the bank on January 28th. Now, however, due to unavoidable factors, the bank could affect the remittance only on 4th of February 2013. The interbank rates were as follows. Now, the interbank rates are given both on 28th of January and on 4th of February. So rates, for US dollar versus rupees, pound versus US dollars, and then Singapore versus pound. Three rates are given. Okay, fine. So there is no direct quote for Singapore dollar versus rupee. So we need to calculate the rate for Singapore dollar, on both the dates. Okay, on both the dates we have to calculate to understand, how much, either he's losing or how much he's gaining because of the, the payment was made only on February 4th, 2013, as against it was supposed to be made on, January 28, 2013. The bank wishes to retain an exchange margin of 0.125%. Okay, so what is required? How much does the customer stand to gain or lose due to the delay? Note, calculate the rate in multiples of 0.001. So we don't have to round it off, but we have to just calculate the rates. Only when the question says round it off, then you have to use the rounding off technique. Now, so we are going to calculate the rates on both the days. Okay, so we know that there are 2 days. One is, January 28, the day on which he wanted the money to be paid, but actually the payment happened on 4th of February. Now, the US dollar rate was, if you look, because the payment has to be made, we have to look at the ask rate. It was supposed to be made at 45.90. Actually, the payment was made at 45.97. So he's losing, isn't it? Because the payment is happening after a few days. Okay. Now, the £1 rate in terms of US dollars was 1.78. And it has actually, the pound has, depreciated from 28th January to 4th of February. It came down from 178 to 1.77. Anyway, so when we look at the quote in terms of Singapore dollar versus pound, okay, where, this quote is actually, since he is going to buy Singapore dollars, okay, so the quote should have been converted first in terms of one Singapore. This is an indirect quote. So we need to convert this into a direct quote and then calculate what is one Singapore dollar in terms of, pound. So this has also, the rate has gone from 3.1575 to 3.1380. Okay. So these are the quotes given to you. Now, what we are going to do is, we are going to, because there are 3 rates given. So we are going to do rupee upon dollar into dollar upon Great British pound into pound, pound. So where is the screen gone? So this is there and this is going to be this. I'll just make a correction here. So I think the screen, I have lost the screen, so I'm just going to share the screen again. So these are the quotes given to you. Okay, fine. So, it is rupee divided by US dollar into US dollar divided by Great Britain pound. Okay, into Great Britain pound divided by Singapore dollar. So what will happen? US dollar will cancel out. So Great Britain pound will also get cancelled out. So we'll have rupee upon Singapore dollar. So we need to have these rates. Now, since the first two rates are in order, only the third rate, which is, given in European terms. So this is, the European, this is, American, this is European. So we need to convert this into also into American. Okay. So, so this means 45.90. Okay. This rate, ask rate, multiplied by 1.7850, which is the ask rate, divided by 3.15, because the quote has been given in the reverse order. So this will go and we'll make a division. So we actually are multiplied by 1 divided by 3.1575. So actually, we can also say that we are actually multiplying by 1 divided by 3.575. So this is the bid rate, so that will become the ask rate. So if we do this, we can just calculate the 1 Singapore dollar interbank rate. Now this will become interbank rate. So it comes to 25.9482 on January 28th. But on February 4th, it came to 26.03. So the rate has moved. The customer wanted to make the payment on January 28th. Had the payment been made at 25.94, it would have been better off. But now, mind you, these are the interbank rates, so we need to add margin. So since these are ask rate, we are going to add 0.125% margin. So the merchant rate will become, 25.9806 and 26.0719. So these are the rates. So that means, if he had, made the payment at 25.98, now he's making the payment at 26.07. So he's losing 0.0913, rupees, and multiplied by 25 lakh Singapore dollar. So the loss comes to 2,28,250. So now this is basically, now just go back and just summarize. Okay. So, the question is given like this. So in the meantime, I'll just say whether you have understood or not. So here, there was a person who wanted to make a payment. He wanted to send 25 lakhs Singapore dollar to his supplier, and he has opened a letter of credit. So he approached the bank on January 28th. He said, I want to make a payment today. But because of some strike or because of some unavoidable factors, the bank could not make the payment or could not remit the money on 28th, but was able to do it on 4th of February. Okay. So, there was no direct quotation between Singapore dollar and rupee. So there were 3 quotes which are given to you. As on January 28th, when you were supposed to make the payment, but actually the payment happened on February 4th, 2030. Now, rate of US dollar is given to you. Now, in this case, we should look for, because he is an importer, so he has to, make a payment. So the ask rates are important. As you can see, the ask rate was 45.90 and it's going up to 45.97. So that means definitely he would be paying more when he makes the payment on 4th of February. Okay, fine. Now, since the direct quote is not given, the quotes are given for US dollar, for pound. Now, pound rates are given in terms of US dollar as well as in Singapore dollars. Okay. Now, we need the rate in terms of, now since we have given, the rate of dollar, so he's going to buy the dollar. Okay. And then he's going to convert the dollar. He's going to buy pound and convert the money into, pound. And then lastly, he's going to convert, convert it in Singapore dollars by buying Singapore dollars. So the last quote is, for buying 1 pound. So you have to convert in terms of buying 1 Singapore dollar. So this way he'll be able to achieve his desired result. Now, this is a 3-way cross rate. Okay. As against normally we are used to about 2-way cross rates. So here it would be like this. First, the step would be that he goes and buy US dollar. Then he goes and sells US dollar and buy pound. The last step would be that he goes and buys Singapore dollar and sells pound. He can achieve this with all the three codes, and that is what we have done actually. Okay. Now exchange margin is given. Okay. So first he's going to buy US dollar. So let's see, on both the cases, he can buy, had the money be paid on 28th January, he would have bought at 45.90. But now, since the payment has happened on February 4th, so he's going to make a payment for actual payment will be at 45.90. So he's going to actually lose money, isn't it? Then he goes and buy £1, okay, and sells his dollars, what he got in the first transaction. So he is going to sell his dollars. Okay, so he's going to buy pound. So he buy pounds. So we have to look at the ask rate. So that's why they are marked in red. Then once he has got dollars with him, he wants to, once he has got, pounds with him. So he has bought pounds. So now he's going to actually, buy a Singapore dollar by selling his pounds. The third code is actually the code for buying £1. So what you have to do, you have to do the reciprocal of it, isn't it? So you have to calculate what is one Singapore dollar equal to how many pounds. So instead of doing that, we know that we can always, divide. Instead of multiplying, we can divide the last one. So what we did was 45.90 into 1.78 divide by 3.15. So because when we convert, the bid will become ask and ask will become bid. So, we are more interested to know what is the ask rate. So 3.1575 will become the ask rate. But of course, it will be 1 divided by 3.15. So if you multiply all the things, we will get what is the quote of one Singapore dollar interbank rate. So we got the interbank quote rate at 25.94 here and 26.3. So we find the interbank account, actually the Singapore dollar has gone up from 25.94 to 26.39. But since the bank is going to charge a margin, so the rates will be converted from interbank to into the merchant rates. So we know that at the ask we always add the margin. If it is a bid, we minus the margin. Ask means the bank is going to buy the dollar at in the interbank market at 26.03941. But when they are going to sell to the customer, they are going to charge a price. So that is their profit margin. So we are going to add. Okay. So it becomes 26.07. In the both cases, we have added to come across what is the merchant rates. Now we have both the merchant rates with us. As on 28th of January, as on 4th of February. We find 4th of February, the Singapore dollar has gone up. Okay. Thereby, he has suffered a loss of 2,28,250 by minusing simply both the rates. And we know that the Singapore dollar has actually appreciated by 0.091 rupee. So we multiply this. So the loss on Singapore dollar will be 25 lakhs into 0.0913, which is 2,28,000. Okay. I hope you have understood. So please, give us the same confirmation that you have followed it. Okay. So that we can move to the next question. So, okay. In March 2009, the multinational industries make the following assessment of dollar rates per British pound to prevail on 1st of September 2009. So these were the rates, which there's a company called Multinational Industries, which is making an assessment, how the British pound will move, or it will be look like on 1st of September. So he's doing their assessment on 1st of March. Okay. So they found this was a probability. Dollar would touch 1.6, 15% probability, 1.7, 20% probability, 1.8, 25. For touching 2, there will be 20%. So what is the expected spot rate on 1st of September? If as of March 2009, the 6-month forward rate is 1.80, should the firm sell forward its pound receivable due on September 2009? So this is the question. Okay. So they're going to receive money. Okay, fine. They are the exporters, so they are going to receive money. They are going to receive at a forward rate of 1.80. So this is the forward rate. Now let's say if we arrive at the spot rate, expected spot rate, it will be 1.81. So $1 would be equal to so many pounds. Therefore, the expected spot rate is 1.81. Now, if as on 2009, the 6-month forward rate is 1.80, should the firm sell forward pound receivable on due? So now the expected rate is basically 1.81, whereas the forward rate is 1.80. So we calculated the expected rate and the forward rate. So it is better if the company's forecasts come true. It will better not to hedge. If they are very confident that the expected rate will prevail, then it will be better that they don't hedge themselves. Okay, so this is the question. Okay, so this question, okay, this is a very important question. So we'll do one more question. Okay, Excel exporters. I hope you are understanding. I don't see anybody reacting. So please do let me know whether you're following or not. Okay. So Excel exporters are holding an export bill in the United States, 1 lakh, due in 60 days. So Excel exporters are holding an export bill. So this is a company which has exported goods to US, 1 lakh, and this is due after 60 days. The following, they are worried about the US rate, the value which is currently at 45.60. Today, the dollar rate is, say, for example, 45 rupees 60 paisa per dollar. Okay, now of course it is more than 83, but let's assume that it was a long time back. It was 45.8. So this was the spot rate at that time. The concerned export consignment has been priced on an exchange rate of 45.50. So they are exporters. Okay, so if the dollar goes up, they would be very happy. So currently it is selling at 45.60, but the consignment was actually priced in at the rate of 45.50. The firm bankers have quoted the rate of 45.20. So 60 days forward rate is 45.20, which means the forward rate has come down. So the dollar has actually depreciated. So the exporter is going to lose money. Rate of discount quoted by the bank and probable loss of operating profit if the forward rate is agreed to. Now, if they go for a forward rate, what happens? We know that we can calculate rate of discount, whether the currency is quoting at discount or at premium by taking forward rate minus the spot rate divided by spot rate into 100. So we did that. 45.20 was the rate, forward rate, and 45.60 was the spot rate divided by 45.6. So into 365 divided by 60 into 100. So we got that this currency is trading at a discount at 5.33%. Now, probable loss of operating profit. So when we have to calculate the loss of operating profit, we have to take forward rate, the rate at which they are going to get their money, minus the rate exchange rate, which was at which we priced their consignment. So their forward rate is how much? 45.20, which is given the question. At what price they have worked out their operating profit, which was 45.50. So here we are not going to take the spot rate, but we are going to take the rate at which they have priced in. So into $1 lakh, so that means they are going to suffer a loss of rupees 30,000, because the forward rate is 45.20, so they're going to get the money at 45.20. Whereas while working out their profitability and their internal exercise, so they have done it on the basis of 45. So they do. So now, okay. So this completes the forwards. Okay. So what I'm going to do is now I'm going to move them to the futures. So we are going to start now understanding what are currency futures market. Okay. And we will try to do some questions today. The futures market. So today we are going to talk about futures market. Tomorrow we are going to talk about the options market. And we are going to do some futures questions also tomorrow. If we are unable to do it, all the questions today. So every business is subject to risk of unforeseeable changes in business environment. Volatility in exchange rate affects your business growth and can be significant. If you are an exporter, importer, or have a foreign currency loan, you are directly exposed to exchange rate fluctuation. It is possible to mitigate these risks by using suitable instruments. So we have, okay, yes, sir, understood. Commodity, sir, why we take exchange rate instead of spot rate? Exchange rate instead of spot rate. No, actually, why we have done is that, when we are trying to calculate what is the loss, so we are taking basically the forward rate minus the rate in which your consignment was, at the time when you worked out, what will be the rate of dollar, so or the currency. So you're trying to say how much loss or profit you have made at what rate actually you have priced your consignment. So we have not taken the spot rate, but we have taken the rate at which it was, they had worked out. Okay. So let's now these things. So currency futures. Now this is very important. So please, Kumari, Jyoti, Satish, everybody, please focus here. Okay. So this is the most important, and we are entering into the most difficult part of our journey of understanding, these things. So this is this will be, if you understand the basics, you will not find it difficult. But this is, the most important and the difficult part of our journey. Currency derivatives are future and options contract traded on the exchanges, similar to future and options stocks, similar to this thing. So they're similar to the stocks, F&O. However, underlying assets of these contracts are currency pairs such as USD INR, Euro INR, Japanese INR, and Pound INR. So the underlying transactions would be either, USD INR or Euro INR or Japanese INR or Pound INR. Now, Indian markets actually, gives you futures market in these 4 major currencies. Okay. And in India, this is relevant to India that there are only 4 currency pairs which are traded on the futures market. Future contracts in USD INR, future contracts in Euro INR, Pound INR, and Japanese INR. Okay. So there are 4 pairs of currency which are traded in India. Of course, in abroad, you can go and trade in any currencies. It depends upon what they are offering. So there are monthly contracts here. Okay. So there are 12 monthly contracts. Okay. For example, today we are in the month of February, and this last day of the month. Okay. February 20, March, April, May, June, like this. So there will be 12 monthly contracts. Okay. So you have to focus only in that month when you are going to either receive or making the payment. Other monthly contracts, you don't have to look at all. So you have to focus only the contract which is applicable to you. Of course, apart from that, there are some weekly contracts in dollar versus INR, which we are ignoring. So, all the weekly expiry contracts will expire on Friday of the expiring. Okay. All the monthly contracts, which are important, they will expire 2 days prior to the last business day at 12:30. So all that, if you have taken up futures position, it will expire 2 days before the last working day at 12:30. Now the contract size, there is a standard size here. This is very important for you to understand because many questions in CA the contract size is given. So there is a lot size here. So lot size is 1,000 US dollar for USD INR pair. For euro, it is 1,000 lot size for euros, and for pound there is 1,000 pounds lot size and 1 lakh yen for Japanese INR. So this is the lot size. So if you have to take a position, either you have to buy futures or sell futures, you have to do in terms of lots. Okay, this is a standard. Now, when you enter the trade, you have to pay a margin. In CA study material, it has been called variation margin. So there is 2 kinds of margin: span margin and exposure margin. So you pay around 2.5% money as a margin upfront to the stock exchange. And this is basically to make sure that you're serious and the transaction can be properly dealt with in the stock exchange, so that there is no chance of any failure of the transaction. So you have to make a deposit before you enter in a trade, and it's called a span margin. Span is nothing but a software which helps the stock exchange to understand how much margin they need to collect based on the volatility of the currency pair. So as of now, the rate is about 2.5%. Okay, it can change from 2.25% or 2.6% or whatever. Currently, it is hovering around 2.5%. Now, the settlement price, how the futures are settled. We will look at the RBI reference rate on the final settlement. Okay, so the RBI is going to give a price of dollar, euro, pound. Okay, and this will be treated as a spot rate on that day, because we will find different rates everywhere. So RBI is going to give a rate. What is the rate on the final day? So all the deals which are in the stock exchange will be settled at this spot rate. Okay, so let's understand this through an example. Okay, so please focus here. Very good, important one. So example on hedging using currency futures. Suppose you are an importer. Okay, you're trying to hedge your currency futures. You're going to stock exchange now. You're not going to a bank, but you're going to the stock exchange window and doing your hedging. So XYZ is an importer. Okay. Now on 28th of February, this was yesterday, XYZ Limited wished to book its outward remittance for 28th of March 2024 worth $1 lakh. So that means this is basically an importer who wanted to make a payment of $1 lakh when on 28th of March 2024. How much? $1 lakh. On 28th of February 2024, so he went to the stock exchange. Okay, the future was trading at 83.0175. So the future was trading at 83.0175 LTP. LTP is last trading price. So when you are going to place your order, so you look at price at which the last transaction had happened. Now you can always either go for at a market rate, or you can say a limit rate, and you say, okay, I want to buy at 83.0175 only. So you place an order at a limit price, or you can even go for a market price. So whatever is the market rate which will come, so you will get your dollars at that rate. You are going to book your contract at that. It can be different than the last trading price. So here the expiry period is 28th of March. So since you have to make a payment in the month of March, so you have to go to the March window, not February, not April. So you're going to look only at the March contract. Okay. So when you went to the March contract, you found that the future was trading at on 28th of February, the future was trading at 83.0175. Okay. Now that means you have now $1 lakh. So you have to buy contracts. So $1 lakh divided by 1,000. So you have to take position in 100 contracts. Now what you are going to do? You are going to buy currency futures. Okay. So example, suppose you enter the stock exchange, you enter 83.0175, assuming that your order has been accepted by the stock exchange, because there is another person who is selling the futures, so he has accepted that. So this contract will get immediately locked in, and you have bought currency futures at 100 contracts at 83.0. The moment you do this, you will have to pay a margin, which I told you it is 2.25%. So 83.0175 is the price what you have chosen, multiplied by $1 lakh into 2.25. So you have to pay a margin of 1,86,963. Now, just to for your benefit, I'm just going to take you to the stock exchange so that you can understand what I'm talking about. Just bear with me. I'm just opening another window. just wait for a minute. I'm just. So I moved to the place, so now I'm going to share it with you. Okay, so I'm just going to share the screen now, what I've just opened. Okay, so I hope you can see the screen now. Okay, so this is, we are actually into the stock exchange trading account. Okay, so we are using ICAI securities and we are hooked up to National Stock Exchange. Okay, so we go to currency markets. Okay, so look at the tab which I'm pressing, currency market. And then we are going to say we want to buy, say, dollars. So as an importer, we are going to buy dollars. Okay, fine. So now there's a futures, there's the options. So we are interested in futures. Okay, so now I have to enter is USD INR. So I have to press the code. So then I have to select the contract. Okay, so now I'm going to buy. So this is the current spot rate, and then we have the various rates. Okay, so we have rates right up to full 1 year, up to January 2025. So if you look at January 2025, the price is 84.14, and as of today, the rate is only 82.89. So going forward, the dollar is going up. So now the current spot is 82.89, and I'm supposed to make a payment on 28th of March. So for me, this rate is valid. Okay, so I'll say, okay, I want to buy the dollar at this rate. This was the last transaction which was completed in the stock exchange. So I'll say buy, okay, to place my order. So when I say buy, so I have to buy 100 lots. Okay, fine. So I have to say 100 lots. So that means I have to pay a margin money of 1,87,000. Okay, and then I can, give a order type. I can put this rate, which is the last traded price, or I can say market. So then the price will go. So I will be able to place the order at the rate which will be prevalent at the time when somebody accepts my order. Okay, if I say put a limit order, then I can always put the price of 83.0850, which is the last traded offer. So if I think that the dollar is going to appreciate, so I'm going to immediately put this rate so that I get immediately the current rate. If I think the dollar will go down, then I can always put a little bit rate a little lower than this. I can say 600. Okay, so I can put any rate. So whenever the rate comes to the level, my order will get executed. Okay. So I'm just coming now back to the screen. So I'm back to the screen now. Sir, this is future. We are going to March. Why not February? Yeah. So this is by Shruti Janeja. Now here, it all depends upon. That's a very good question. Now look at this question again. To understand what we have done doing it. Why not? So it all depends upon which month we are going to make the payment. If suppose we are going to make the payment in March, then we have to see the March contract. If we are going to make the payment in the month of, now look at this. So what he's saying is on 28th of February, he wants to make the payment when? On 28th of March. So today is 28th of February. So he says, I want to make the payment after a month. Okay. So he will go to the stock exchange and look the monthly contracts and stop in the month of March. Okay, and go into the March contract and book his order. Okay, so he's going to book his order. So he saw the price was 83.01. Okay, which is the current, of course, price we have seen a little bit different because of, that I just opened the screen yesterday. So this was the time when I was getting. So I'm just going to. So he's going to, first of all, he's going to ascertain how many contracts he needs to buy. So $1 lakh divided by the number of contracts, which is going to be, 100 contracts. So he's going to buy. So he's going to buy this thing. So buy currency futures, 100 contracts. What is the price? 83.01, assuming that his order got executed. So then he has to pay, the second thing he's going to do is he's going to pay a margin, okay, which the exchange will tell him at what rate he's going to pay the margin. Okay, so the margin will be 2 lakh, 2.25%, which is 86.96. And then, the spot price on that day when I was booking the order was 82.90. Okay, so the currency future price will go up slightly. And as we see that, we went, in the month of next year, January, the rate was going up to 84. So because, the dollar is appreciating over the period of 1 year. Okay, so this is, now we are buying the currency futures. Why we buy, first of all? Now, in currency markets, futures market, particularly stock exchange, we will not get dollars. We have to buy the dollars from the bank. Okay, so we're not going to get dollars. Neither we are going to get dollars, nor not we are going to get, we are going to, receive dollars. So we are going to get, our settlement going to happen only in cash. Okay, so here I'm buying currency futures. So, if I'm an importer, I am actually exposed to what? Dollars. Okay, so I'm going to buy futures. That means I'm taking a long position in currency futures, or in one way, I'm bullish on dollar. Because if the dollar goes up, I'm going to make money in the stock exchange, but I'm going to lose in my real transaction. So both will get offset. So let's understand. Let's see first case. The first case is, suppose on 28th of March, which is the day when the settlements happen, which is the expiry date, and it happens to the date in which I'm going to make the payment also. Okay, I've chosen the same date, expiry as well as date of payment, same. So on month end, the case one, what happens is that the dollar goes up to 84.51. So this is the RBI rate. So RBI announced the rate, and they gave a rate of 84.5175. Since I have bought the dollars at a lower rate from someone, if I place an order, what happens is if I place an order, so I have placed the order at 83.01. So that means I have bought dollars at this rate from someone, which he has to, from someone till 28th of March, I have a window to buy the dollars at 83. So I have entered into a contract to buy dollars at 83.0175. Okay, so this is a derivative contract that I have bought dollars from someone, and I can exercise, I can buy it anytime before 28th of March. So since I bought the dollars at 83.0, this thing, now the rate has come to 84.51. That means I am making a gain. I have bought something at 83. The price is today 84.51. So I'll get profit. The profit will be calculated as 84.51 minus 83. So I am making a gain of 1,50,000. Now, stock exchange is not going to give me dollars. Now, I have traded with someone. I have bought futures. Somebody has sold futures. Okay. So the other party is going to pay me 1,50,000. Who has sold the futures to me? He is going to pay 1,50,000 to the stock exchange, and stock exchange is going to give the money to me. So I'm going to make a cash. So whatever margin money I had paid, that money I'll get in totality. I'm going to get the whole of the margin money. Now, but then what happens? I've got a cash profit of 1,50,000. Now importer has to pay 84,51,750 on 28th March at the spot rate to his banker on the due date. Now, my underlying transaction was that I have to make $1 lakh. Now, assuming the spot rate is 84.5175, which was published by RBI. So I'm going to make a payment around that rate to my banker, which is going to be 84,51,000. Okay. But since I have got a profit from the stock exchange of 1,50,000, so I lost in the spot market, but I gained from the stock exchange market. So, which means that my net outflow will be only 83 lakh 1,750, which means I am hedged. I have hedged my position at 83.01. Okay. So he is hedged and the amount, fixed his amount at 83.01. So at the rate what I bought, so that is the rate what I am going to pay ultimately. So whatever happens to the state of dollar, if the dollar goes up, then I'm going to make a cash profit from the stock exchange, and that will nullify my loss in the actual spot market when I'm going to make a payment to my bankers. So net result will be I'm totally hedged. Okay, let's take a second example where the dollar has gone down. So instead of going up, it has gone down. So it has gone down to 82.01, which means I'm going to lose. So if I have sold to someone at 83, the price is 82. Okay, if suppose I have bought at 83 and the price is 82, so I'm losing money. Okay, so I have to give 1 lakh rupees to the stock exchange. It will be given to the basically the seller, the future seller. So he will get the money 1 lakh. I'm going to lose 1 lakh because I bought something at 83, which is today 82 rupees only. Okay, I bought something at 83, which is today worth 82. So I'm losing 1 lakh, isn't it? So this is the money of loss which I'm going to lose. So margin will get released immediately on 28th of March. But now what happens? On 28th of March, because the rate is 82.0175, so I go to the bank and make a payment of 82 lakh 1,750 because the spot rate turns out to be lower. Of course, if I would not hedged, I would have been happy a lot. But since I have hedged, so I'm losing 1 lakh rupees. So my net outflow would be again, in a position where it will be 83.0175. So that means net outflow will be 82 lakh 1,750 plus 1 lakh rupees loss, which I have suffered from the stock exchange. So net outflow will be 83 lakh 1,750. So again, I find that I am completely hedged. Whatever happens to the, the dollar price, whether it goes up, when it goes up, I make a profit in the stock exchange, but I lose on my underlying transaction because I have to pay more money to the bank. So both get nullified. So let's go back and see here. Case one, here, the dollar has gone up. The dollar has gone up. I have taken a long position in the dollar. I'm bullish on the dollar. I have just taken the opposite position, what actually position I have in my, underlying transaction, so that I gain from the stock exchange, and the gain is going to offset my losses in the spot market transaction when I actually make the payment to the banker. Okay, so I have suffered I made a cash profit because I have taken a long position. I have sold my dollars at 83.01 at the time when I entered the contract. Okay, so I have a right to sell my dollars at 83.0175 anytime up to 28th of March. I entered into this derivative contract to the stock exchange with someone, and he accepts my bet, and he actually sells the futures. He sells the dollars to me at 83.01. So I have bought the dollar, somebody has sold. Now, since the dollar has gone to 84.51, instead of exchanging dollars, we exchange cash. So since I have made a profit of it, the dollar price is today 84.51. The time when I bought it was 83. So I am sitting on a profit of 1 rupee 50 paisa into $1 lakh. So I'll be making a profit. So my bank account, I'll get 1,50,000. So when I check my bank account, I'll find that I have received 1,50,000 from the stock exchange. Okay. On 28th of March, the contract is over. 2 days before the month end, the stock exchange closes the transaction. So margin which I paid earlier, 1,87,000, I'll get it back. Now, when I go to the bank to make full payment to my supplier, the bank will say the rate today is 84.51. So I have to make a payment of 84,51,750 on 28th of March. But if I see, I have paid 84,51,750, but I have got 1,50,000 from the stock exchange because of my hedging position there. So ultimately, my total outflow is 83,01,750. So which means that I'm hedged at 83.01 per dollar. So this is the position which I took initially. So I'm hedged. So the second case would be that if it happens other way around, that suppose the dollar goes down now to 82.0175. Suppose that there can be only two scenarios possible. One, the dollar has gone up, another is dollar has gone down. So when it goes up, I make money. When it goes down, I lose money. So I lose a rupee per dollar. Okay. So I have to pay 1 lakh to the person who has sold me the dollars at 82, because at 83, okay. So because today the dollar price is 82, so I'm suffering a loss of 1 rupee. So I'll give 1 lakh rupees to the seller, okay, so that so I've suffered a 1 lakh loss, okay. So that means the margin will get released, and the importer has now to pay 82 lakh 1,750 on 28th of March, okay, fine. So on the due date to the banker. So when he goes to the bank says that you have to pay $1 lakh to someone, pay us at the rate of 82.0175. So actual transaction, physical delivery will happen only in the real market, which is with the bank and you. So you are going to make a payment of 82 lakh 1,000. But you have actually suffered a loss. So that means you have to pay another, you have paid 1 lakh loss. So the total outflow will be 82 lakh 1,000 plus 1 lakh. So actually you are hedged at, your payment has been hedged at 83.01. Okay. So whatever happens when the dollar goes up or down, so whatever position you have taken, that is the rate at which, when you're bought at certain price, that is the price you're hedged at. So let's take about example of an exporter. Okay. So very important. So before we finish, this is very important thing. So please understand, you are now an exporter. So XYZ is an exporter. Now he is going to get 1 lakh rupees. Now, this slide I have not updated. So on 29th of January, which was last month, he opened his screen. Okay, he hooked it to the terminal, and he saw that he has to make a payment. He has to receive a payment now, $1 lakh. How much? On $1 lakh on 28th of March. He's supposed to receive 1 lakh rupees. So in this case, you are an exporter. You are going to get 1 lakh rupees when? On 28th of March. So you today assume the date is 29th of January. So you saw the dollar future is selling at 83.31, expiry 28th of March. So this is the March window when you saw it was selling at 83. Around 29 January, this was the date. So again, you have to look at how many contracts you have to choose. So you have to choose 100 contracts, $1 lakh divided by 100. Now you have to, instead of buying, this thing, you have to sell currency futures. Okay. So you have to now, as an exporter, you need to sell. As an importer, you need to buy. Because, when you sell, you have sold something to someone at 83.31. Okay. So you have sold the currency futures. That means you have sold somebody dollar at 83.31. Even if the dollar goes down, you're not going to suffer any loss. Okay. Fine. So you paid a margin of 2.25. Now the first scenario would be the dollar has actually gone down. The dollar has gone down. So, you are an exporter. You would have been worried, man, if you would have not taken a hedge. But since you have taken a hedge, you're sitting on a profit of 1 lakh. You have sold to someone at 83.31, and today the price is 82.31, which is 28th of March date when you are supposed to receive dollars. So the price was 82.31. Okay. So you making a cash profit, the margin will get released by the stock exchanges, and now the exporter is going to get only 82 lakh 31,000 from the banker, because the banker will say the rate is 82.31. So we are going to give you 82 lakhs 31,000. Since he has got 1 lakh rupees from the stock exchange, so his net rate will be that his net receipts will be 83 lakh 31,750. So that means he is hedged his receipts at 83.31. So whatever happens, he will be getting the rate at which he has sold the currency futures. Okay. Then the second scenario would be that instead of the dollar going up, the dollar going down, it has gone up. So now the dollar has gone up. So you're an exporter. If you are not hedged yourself, You're a very happy man, but sorry, you have hedged yourself, so you're not going to get 84.61. So you're going to suffer a loss of 1 rupee, of 30,000, sorry, 1 into 1 rupee 30 paisa, isn't it? Yeah. So you're going to suffer a loss of 1,30,000. So you're going to pay this 1 lakh rupees because you have sold to someone at 83.31, okay, but it is now 84. So you need to either buy it and give it to him, or you just share the loss. So if it was physical settlement was possible, since you have sold someone 83.831, so you have to buy from the spot market at 84.61 and sell to someone at 83.31. That means you would have suffered a loss of 1 rupee 30 paisa, which is on $1 lakh, it is 1,30,000. So the stock exchange says that you don't have to buy and sell dollars. You just do a cash settlement. Okay, so I have to pay 1,30,000 to someone who has bought from me. I have sold, he has bought. I have bought, I have sold, he has bought. So I have to pay him 1,30,000. Margin will get released. Now exporter is going to get 84,61,000. He would have been very happy in such situation, but his happiness will be short-lived because he's already suffered a loss of 1,30,000 and he's hedged at 83.31. So whatever happens to the dollar rate, whether it goes up or goes down, whatever at rate he has sold his dollars in the futures market, that is the rate at which he's going to be hedged at. Okay, so do you want that I should just summarize the second one again? Which position to take in the spot market and future market? Now, let's understand now. How do we decide about what kind of position one has to take? So let's go back to the case of importer. I'm just taking you back to the importer. Okay, so here you are an importer. Okay, so whatever your position is in your real transaction, since you are an importer, you have to make a payment to someone. Okay, so you don't have dollars, so you are short on dollars. So you're going to take a long position in futures in dollars. Okay, so you are short in dollars, you don't have dollars, so you take a long position. You have to buy currency futures as an importer. But as an exporter, you have to just take the opposite position, because under exports, you're going to receive the money. You're going to receive dollars. So you are long on dollars, so you're going to take a short position in dollars. That means you're going to sell currency futures. Okay. Now, in case of an importer, when you take, opposite position of what you hold in your real life world, which is that means you are short of dollars, you're going to take a long position in currency futures in dollars. So you're going to make money in the stock exchange versus what you're going to lose in your real transaction, on your import transaction. So here, when the dollar went up, you made a profit, okay? But that profit was got, offset from whatever you are supposed to pay in your real transaction. You paid 84 lakhs, but you gained 1 lakh. So that means net, you have actually, got your position, this thing, you were totally hedged. So whatever your position is in that currency, now in this case, the currency is dollar. So as an importer, you are basically, as an importer, you are short of dollars. You don't have dollars, but you have to supposed to make a payment after some time. Just take the opposite position in the stock exchange. If you are short, take a long. Long means you have to buy. So when you buy in stock exchange, you will make money when the dollar goes up. So that profit will get offset against your losses, which you are going to incur in the actual transaction. So it will keep you completely hedged at the rate at which you have bought the dollars. So in this case, let's say you have bought the dollars at 83.0175. Now, whatever happens, whether the dollar goes up or goes down, you're actually hedged that you will be making a payment at 83.01. So your net outflow from the company will be only at 83.0175. Now, look at this here. The dollar had gone up. So you would have been a worried man. If you were an importer, you're not hedged, but thanks God you're hedged. So you're going to make a profit of 1 lakh. And the loss what you made in the spot market and paid little more at 84.51. So your net outflow will be restricted only to 83 lakhs 1,750. So that means you are hedged at 83.01. Okay. Now, second case, assume the dollar has gone down. When the dollar goes down, you make a loss as an importer. Okay. I mean, you make a loss because in your position, you have assumed a bullish position in the dollar, but actually the dollar came down. So you're going to lose money in the stock exchange. So you lost 1 lakh rupees. But you know what will happen in the market? You have to pay less as an importer to the bank because the spot rate is now 82.01. So this plus the loss, you will be at the same position. So you will not be able to encash the profit because of the dollar going down in the spot market when you make the payment to the bank. But since you have suffered a loss, so that means your total outflow will be at 83.01, whatever may be the case. So you're hedged. So you're not going to pocket the gains here, okay? Because you're hedged. So your loss will make sure that your outflow happens at 83.01. So similarly at exporter, what will happen? You're an exporter. So here you're going to suppose receive money. If you have to suppose receive the money, that means you are long on dollars. So you should take a short position. Short means you're going to sell futures. So here you're going to sell the currency futures. If you are long on dollars, you should take a short position. If you are short on dollars, you should take a long position. So as an importer, you take a long position, you buy dollars. As an exporter, if you have you're long on dollars, you're going to get dollars now because you're long. You're going to get your dollars from your customer, but you should take a short. I mean, you should sell currency futures. You should take a short position, opposite position of whatever you have in your real life. So in that currency, mind you, in that currency, okay? So I'll explain to you why I say that later on. So the margin will be paid. Now in this case, since you have sold futures and the rate has come down, so you have sold it at a higher rate, so you're sitting on a profit. And had you not taken a hedge, you would have actually got 82,31,000. But the loss which you have suffered will get compensated because you have made a 1 lakh rupees gain here. So that means you are hedged at a higher price at 83.31. Second scenario, if the dollar goes up, if you are not hedged yourself, then you would have been very happy person, but you have hedged. So you So we are going to start again. I'm just going to share the slide. Okay, so sorry, student, there was a power failure at my end, so I think that's why we lost the connection. So we are just resuming. So we'll be doing one more question before we close for the today, or maybe one or two questions. Okay. So exercise number 25. So I'm not yet connected to your chat box because okay, now I'm connected. So fine. So you can send me your queries if possible. So I was totally off because of the basic. I hope you can now see me back on the screen. Okay. So ABC Technologic is expecting to receive a sum of 4 lakh after 3 months. So the question is that there's a company which is going to receive 4 lakhs after 3 months. Okay. The company has decided to go for a futures contract to hedge against the risks. Now, this is a question which came in your CA study materials, one of your CA exams. The standardized size of the future contract available in market is 1,000. As on date, spot and futures dollar contracts are quoting at rupees 44 as well as 45 respectively. Suppose after 3 months, the company closes out its position. Futures are quoting at 44.50 and spot rate is quoting at 44.50. You are required to calculate the effective realization for the company while selling receivables. Also calculate how company has been benefited by using future options. Okay. So this is basically the question. Okay. The company can hedge position by selling futures. Now, since you are basically an exporter. Okay, if you see that you are expecting to receive US dollar after how many months? After 3 months. Let me see if there's a problem here. So there's some problem here. Okay. So you are going to receive 4 lakh rupees. So you are an exporter, isn't it? So since you are an exporter, so you have a long position, in your dollars. So you're going to sell currency futures. So sell currency futures. Okay. A company can hedge position by selling futures contract as he receive the amount from outside. So number of contracts would be how much? 4 lakh divided by 1,000 is the lot size. So 400 contracts. So after 3 months, the future price is 44.450 and the spot price is 44.50, the same price. Okay. So that means company closes out its position at 44.50. Okay. So what is the gain? They bought, they sold currency futures at 45 and now they are selling it at 44.5. So they, sold at 45, they bought it at 44, or in the market, it got closed at 44.50. This was the spot rate on that day. So that means into 4 lakh dollar. So that means they will be making a profit of 2 lakhs. So this will be from the futures trade they will be making. So the difference would be the profit. That the position that they took was, they sold the currency futures at 45 and the spot rate on the last working day was 44.5. So that means they're sitting on a profit of how much? 50 paisa. Multiplied by 2 lakh, 4 lakh dollars. So they made a profit of 2 lakhs. Now, since they have done it, so they would be net inflow after 3 months will be 44.5, which is the spot rate. So they're going to get this much of money. Okay, 4 lakh dollars into 44.5. This is the spot rate from the bankers plus 2 lakh rupees profit they have made from the stock exchange. So that means they are having a total net inflow of 1 crore 80 lakhs. So now let's again revisit. Net inflow after 3 months will be how much? 44.5, which is the spot rate. So the bankers will give them this much of money, 44.5 into $4 lakh, plus 2 lakh rupees, which they have actually earned in the stock exchange by taking a short position there. And whereas the dollar has gone basically further down, so they're making money on that. They sold and they bought at lower price. So it means they are sitting on a profit of 1 crore 80 lakhs. Total overall inflow is 1 crore 80 lakhs. So effective price will be 1 crore 80 divided by 4 lakh, which is 45. So the effective price works out to be the same as at which they sold their, currency futures. So they are effectively, this is the answer for this question. Okay, fine. So this is the question. So now, before we break, and next time tomorrow we are going to have. So let's see if we can do some MCQs. Okay. So I'm just going to another slide. Okay, so which of the following is not a type of foreign exchange exposure? So, if you have some doubts, you can just go and watch the video. And tomorrow morning, we are going to just have a little bit of more summary of futures and do some more important questions which came in your exam. So till the time, we can just, focus on this. Which of the following is not a type of foreign exchange exposure? Economic exposure, translation exposure, transaction exposure, or income tax exposure? Tell me that. So I'll just wait for your response. Which one is not a type of foreign exchange exposure? I think I am reaching to you. Okay, I'm not sharing the screen. Okay. Okay, I'll just share the screen. Okay. Yeah. So this is the question. Okay. I think now you are able to see the screen. Okay. Fine. Which of the following is not a type of foreign exchange exposure? Economic exposure, translation exposure, transaction exposure, or income tax exposure? So now it is visible, I believe. Namrata? Sorry, I just changed the slide and we could forward to share. So it's the income tax exposure. Absolutely right, Suraj. Now next question. Today, €1 can purchase $1.13. This is a spot exchange rate, forward exchange rate, fixed exchange rate, money exchange rate, or financial exchange rate. Tell me. Today, €1 can be purchased at $1.13. So what is this exchange rate? D is the answer, right answer. But for second, what is the answer? Second one is it actually is the spot exchange rate. Okay. So I think by now you might have, attempted your answers. Okay. Second one. Second one is A. Is that okay? Okay. Now, absolutely right. Now, third, in an agreement to exchange dollars for euros, 3-month spot rate is dollar so much. The price is spot exchange rate, money exchange rate, forward exchange rate, monthly exchange rate, or a fixed exchange rate. So third, please answer this. So third one. A, C. Answer is C. Okay. So third answer is what? In 3 months. So this is the forward exchange rate. So the answer is C. Very good. So now another one. When the value of British pound changes from $1.25 to $1.5, then The pound has appreciated and the dollar has depreciated. The pound has depreciated and dollar has appreciated. The pound has appreciated and dollar has depreciated. Okay, or the pound has depreciated and the dollar has depreciated. Tell me which one is the right one. So the answer is C. Absolutely right. C is the right answer. When the value of the British pound changes. Okay, now fifth. Now tell me, if the British pound appreciates from $0.50 to 0.75 per dollar, the dollar depreciates from dash to dash pounds per dollar. Now, please look at this question, fifth one. Okay. Write the question number in front of your answer. Like, what Namrata has written. So, the answer is B here. Right? If the British pound appreciates from $0.50 to $0.75, the dollar depreciates from, just do the reciprocal and find out. So 1 divided by 1.5 would be 2. So 2 would be the right answer in any case. So what would be the answer? So the answer is B, which is the B part. So here the answer is B. Absolutely right, Shruti. Now, sixth. The spot rate is the rate paid for delivery. So I'll just skip that. Okay. Foreign currency exposures can be avoided by entering into a forward contract, buying a spot rate, arbitrage, none of the above. So here the answer would be buying at forward rates. Okay. Seventh answer would be A. So put your answers. So just one more minute and we are going to just close for the day. One more, question. 8. The exchange rates quoted by an authorized dealer to its customer is known as what? The exchange rates, quoted by authorized dealer to its customer is known as, seventh was A. Seventh was A, right? 8. The exchange rate quoted by authorized dealer to its customer is known as merchant rates. Okay, so we know that. So let's see how many people have answered right. 8. Eight is B. Please explain question number 6. Okay. The spot rate is the rate paid for delivery within 2 business days after the day of transaction. Okay. So because this is the norm here, it is T plus 2. That's why it is. Now here we basically end our sessions for the day. Okay. So we'll meet tomorrow when we do more futures questions as well as options questions. Okay. Right. So see you tomorrow now. Just let me know how was the session you would be able to understand. We know that we have done some difficult questions today. So if you have followed, please let me know. And if suppose you need something else to be done, please let me know your suggestions. How was the session? So please put your remarks for the sessions today. Okay, then see you guys.